In our reporter's notebook today, the fight to keep companies from leaving California. A stubborn recession and extensive regulation have caused hundreds of companies to pull out of the state in the last 5 years. But there's evidence the tide is starting to turn. CNBC's Jerry Cobb joins us now live from Los Angeles with more. Good afternoon, Jerry.
Good afternoon, Sue. You know, other states have used tax breaks, training subsidies, and a host of other incentives to rustle hundreds of firms out of California during the recent recession. Yet, battered and bruised, the state is starting to fight back and occasionally win. Squeezed by tough clean air laws and lured by cheap labor in Mexico, furniture companies have been leaving California in droves. But when Verco Manufacturing considered moving its 400-employee operation, state and local officials convinced the company to stay by offering incentives that made it easier to purchase new equipment and retrain workers.
We've been told that we'll get a job training credit for that, and we appreciate that, and that's very helpful. That could be $500,000. There's also saving on the taxes, sales tax for that equipment. And again, that's going to be a lot of money based on how much we buy.
Verco's experience shows how far California has come in keeping businesses from leaving the state. More than 1,200 have pulled out in the last decade, taking more than 260,000 manufacturing jobs with them. And the battle is far from over.
This is the heavy-duty war between the states. There are 9 states or metro areas that have a permanent office in the Los Angeles area somewhere to try to lure business out of California.
Ironically, California's downturn is beginning to make the state more attractive in some ways. Home prices have come down, commercial and industrial space is cheap, and there's plenty of skilled labor looking for work. Business still gripes about tough environmental regulations, but many are realizing it's better to comply than fly.
Many of those same stringent laws are going to apply in other states as well. There's getting to be more and more uniformity and more awareness on the part of all states as to air and water quality.
Many say the state still needs to further reform its cumbersome permitting process and its infamous workers' compensation system. But talk of serious changes in the air, especially with term limits clearing out the state legislature and competition heating up in the governor's race.
California's tax rates right now, marginal tax rates are almost 50% higher than those of New York State, run by a liberal Democratic governor like Mario Cuomo. I think if New York State can get by on less than 8% tax rate, I think California can also.
There will be a lot more reformist rhetoric like that in the months ahead, but there's an important reality behind it. It's that California's business climate is improving, and instead of finding reasons to leave, more and more firms here are finding reasons to stay. Sue?
Yet, Jerry, we see a lot of headlines. As a matter of fact, there was one in the Wall Street Journal today about Californians, both businesses and individuals, leaving and moving eastward in some cases or northward in others. Do you think that those headlines are somewhat overblown and the media coverage about California's troubles are overblown?
Well, there certainly has been a feeding frenzy on companies leaving California. I'm the only reporter I knew of who picked up this story of this big furniture company staying. Another big story beginning to develop out here is a lot of the companies that have left are starting to come back.
Great. Thanks, Jerry. Jerry Cobb live from Los Angeles. And when we come back, lots more ahead on Market Wrap. Troubles for the bond market aren't over yet.
This is CNBC.
Welcome back. We'll get to Tech Talk in just a couple of seconds, but first we have some news for you hot off the ticker. American Express says that it is going to pay out a dividend of 1 Lehman share per every 5 Amex share that is held. If you will recall, they are spinning off or splitting off their Lehman Brothers unit. American Express says that it expects Lehman stock to start trading as of May 2nd on the New York Stock Exchange. Meantime, lots of news in the markets today, of course, and the dollar was taking center stage, with a lot of traders at this point wondering how low can the greenback go. John Murphy is here with this edition of Tech Talk to give us some guidance on that front. Not a pretty day if you were long. I feel like I said this yesterday in terms of the bond market. Not a pretty day if you were along the bond market. Well, that was true today, but it was the dollar, the culprit of the dollar, which we talked about yesterday.
Well, this week, so a lot of focus has been on the dollar because it has really begun to break down, and that creates a lot of problems for our bond market. market, which eventually hurts the stock market. And the Federal Reserve came in today and tried to support the dollar, somewhat unsuccessfully. But let's start with that. We'll look at the dollar-yen, because that is really, I think, where a lot of this is starting. And we'll take a look at its chart. We're going back last 200 days or so. And actually, since the beginning of the year, the dollar has tumbled from 113 down to about 101. That's a loss of about 10% against the Japanese currency. Now, right around this 101 level, that becomes a very critical area, because that was the closing low that was set last October. And in fact, if the market closes below that, it will be the lowest level since World War II. So the dollar has come down to a very critical support level. It was actually slipping below it earlier in the day today, and the Federal Reserve came in and did start to buy dollars against the yen to try to support this. We did get a minor uptick in the dollar today against the yen, but it doesn't look that good at this point. If we do close under 101, as I indicated earlier in the week, a decline at least down to 95 would be the next downside target, but we're continuing to watch this 101 level very carefully. Now, moving on to another key currency, which is the dollar-mark relationship. We did not fare as well here as we did with the yen, and this is the dollar mark. Notice we peaked here at 176. Now, today we closed below 166. The Federal Reserve also came in today and tried to support the dollar at that 166 level. Why that is significant is that is a low that was set about a month ago, and a close below 166 would put us at a 6-month low, and I think would produce more technical selling in the market. The intervention was unsuccessful. We did close below 166 today, so this indicates that the market is resuming its downtrend, and it looks as if we could eventually get back to the lows that were set last September down in the area of 160. So almost everywhere you look today, the dollar also broke down against the British pound and the Swiss franc. So almost everywhere you look, we are beginning to see some fairly heavy selling of the U.S. dollar.
And part of that, as I understand it, John, was linked to a big move up in commodity prices, and the CRB index was kind of the leader there.
Well, this is part of the problem, Sue, that when the currency begins to weaken, it creates some inflationary pressure, which we've all been talking about. Maybe it's a coincidence, but we had a very sharp rally in a lot of the commodity markets late in the week, which is not a good combination. Let's come back to the CRB index, which is a basket of 21 commodities. We're putting this in a longer-term perspective just to show where we've been over the last year or so. The CRB has rallied about 15% in the last year and just recently set a 3-year high. Now, we've had a pullback of about 4%, but I think it's important to bear in mind that this has the look of just a pullback in an emerging uptrend. Notice, for example, that we have held at our 40-week moving average. That's a good sign for this index. Also notice the breakout point at 220. That's the peak that was set late 1991. Very often a market will pull back to it, and it did that. And as I mentioned, closed the week on a very strong note. We closed up almost 2 points today. 19 of the 21 commodities were strong today. The metals markets were quite strong. The oils closed very strong. And the lumber market, which we've been following very closely, had 3 limit advances late in the week. So we are beginning to see some new signs of strength coming into the CRB index. So commodities closing the week on a very firm note.
Now, what about the raw industrials index? Because that's what a lot of economists follow, John. If they don't follow the CRB index, they follow the Journal of Commerce or the raw industrial index.
I wish they were paying more attention to this next one, so it's kind of a mystery to me. They like to look at this index, but they seem to be ignoring it. Let's look at it. It's an index of spot raw material prices, and we're going back here about 2 years. This is very different from the CRB index. This does not include any food prices, nor does it include any energy prices. These are commodities that are supposedly sensitive to moves in the economy, and also very often acts as a leading, or usually acts as a leading indicator of inflation. Now, notice what has happened since last October. We've been really surging. In fact, we're up about 15%. It's a little bit hard to see here, but this week we actually surged again. This index is trading at about another 18-month high, so no sign of let up here. This thing is just continuing to surge. Now, for those people who don't believe that this is having an impact on bond yields, let's overlay the bond yield on top of that, and what you're going to see basically is a very close correlation between the two, which is normally the case. When this thing comes down in 92, notice it pulled bond yields down, and right here When the raw industrial index turned up, that's when bond yields have been moving higher. And with this thing moving into new highs, it's one of the factors creating upward pressure on these bond yields. Every time it looks as if bond yields are going to back down a little bit, this thing continues to surge. It's at least one of the factors of pulling bond yields higher. What we are looking for is a probable test of the 92 high in the spot raw industrial index. If it backs off from there a little bit, that might create a little relief for the bond market. But this is where some of these early inflationary pressures are coming from. I'm sure that's one of the things that the Federal Reserve Board is looking at.
Okay, so in the 30 seconds that we have left, John, wrap it all up for us. What does it mean in terms of our trading?
Well, longer term, I think it has negative implications. So I am hopeful that on a short-term basis, the bond market is certainly trying very hard to stabilize in this area. The utilities closed the week on a fairly firm note. So I'm hoping for some short-term relief here in the bond market, possibly even in the stock market. But I think longer range, as you go further out, I remain negative on the bond market. And I think that this rally in the stock market is probably not going to get all that far.
Thank you, John. Have a great weekend, and we'll see you on Monday. John Murphy, our technical analyst. Some unusual sights and sounds today at the White House.
This is CNBC.